Welcome back to the Personal Finance Project. I'm Scott. He's Greg. And today we are here to take a look at another FinTalk Reacts series.
Yes, I love this series.
So the way this works, if you haven't tuned in before, is we are going to watch a couple of videos from TikTok, financial services sector, and then give you our initial reactions to the points that they're trying to make. So with that, we will jump right in today.
Let's do it.
One money hack that the rich do not want you to know about. Actually, most wealthy people are happy to tell you how they did it because they know most people won't do it. But for the few that are going to, here it is. When you want to buy something, don't buy it based on the cost and how many dollars you have to pay for it. Buy it based on the interest you need to make off your investments to afford it. For example, something like Netflix is $10 a month. Most people look at that and go, I can afford $10 a month. The few will invest $2,500, paying them $10 a month in interest. If you always look at purchasing through this lens, you will get to a point where you don't have to work again. Follow to get to financial freedom.
Well, my first comment is I need one earphone, but definitely not two.
Overdoing it with two. I think right out of the gate, one of my favorite parts of these videos are this notion that there is a group of people called the rich, and they're hoarding all of these really wonderful money-making ideas from the poor, I suppose, or the rest of us normal people. And I think generally speaking, what people mean by the rich are like the older, you know, because if you look at a cross section of society, generally speaking, those who have most of the money are in their 60s or older. And so I just immediately reject this premise that we are hoarding ideas like letting your investments grow to pay for your lifestyle. Whether or not that's good advice is we're going to discuss it.
Yeah, no,
I dismiss that part of the video out of hand.
I would agree with you on that front.
Yeah. And then on the other part, and we dug into this on the last FinTalk video that we watched, where my fear about advice like this is that this will have a person go out as a young person wanting to pay for their Netflix subscription or their Uber Eats or whatever the case might be by loading their portfolio up with something like high yield bonds. Because now they're saying I've got this immediate interest payment that's going to pay for a lot of my subscriptions. And if I do what this guy says, that's my ticket to financial freedom. But as you can tell, you can kind of hack this in order just to buy very high yielding, but not necessarily long-term total return vehicles in order to pay for your subscriptions. And I just don't think that that's a particularly great way of going about making money.
Yeah, and I guess I would say that my biggest issue with it, even beyond that, is this is all a fancy form of mental accounting, basically, or just kind of find the income versus find the expense. So what this guy's saying is, all right, well, you can have Netflix now because you invested in something that makes $10 a month,
right? Which
I guess that works, but okay, what is your income doing then?
Yeah.
So if you're making money, going to work and earning some income, what is that contributing to? Because I mean, I guess if that's going to saving in high return vehicles while your $2,500 in a CD is paying for your Netflix, I guess that kind of works, but it's kind of the opposite way of thinking about it for me.
Exactly. And I think when you're young and you have the balance of capital that we've talked about many times, you get your human capital, which is basically what your future earnings are going to be. And it's going to be very small when you're young. I mean, your human capital is very large when you're young because you have many, many, many more years of employment over which to earn your actual income, which is what we generally advise people to spend on things. Yes, you save a portion of it, but you spend the income that you're earning on the things that you need. Yes, of course, but also on the things that you want. And then you have your investments, and those are generally to pay yourself once you stop earning an income. And I think a lot of people can get this confused where it's like, well, my investments are supposed to supplement my income. It's like, well, not really. Because like what you said, well, then what is your income doing?
Yeah.
So you're taking money out of your investments to pay for your Netflix and then investing your income over the top and putting it right back in? Like that seems like a needless kind of circular way of doing it.
I totally agree with you. I also think there's kind of a weird phenomenon here that this is maybe on the fringes of a little bit. And some other people that we've had in segments like this have been a part of it as well. But it's like, we're in a country where most people don't save enough, but if you hit a certain point of saving, then you kind of become like this weird flagellant saver where it's like, I'm going to punish myself in never spending a single dime. Like, okay, you know what? If you don't have a CD, you can probably still have Netflix.
Yeah.
If you have a decent job.
Yeah. And I think that it's like we've talked about this at length many times where you've heard it. I think the most, the example for maybe the millennial generation was the cup of coffee a day. It's like if you made your coffee at home instead of going to Starbucks or whatever you like, and you put that money in the S&P 500, the difference there in the S&P 500, and waited for 47 years, you'd have $100 million.
I would be retired if it wasn't for coffee.
Yeah, and I'm exaggerating here, but often the assumptions underlying this particular example are pretty extreme. It's you, with perfect fidelity, you invested the difference in a Roth IRA, so there was no tax implications whatsoever, and the S&P 500 did exactly what it's done historically, somewhere between 10 and 12%. We can quibble about whether or not those are decent assumptions, but mostly, having been around actual human beings, that's not what people do. Most people, they have some sense of what they're earning, and in the United States, what you earn is a pretty good indication of what you're going to spend. So I think rather than doing some esoteric, calculation about what your CD is earning at prevailing rates and whether or not you can afford to have Netflix this month, that sounds like a nightmare. Instead, taking from, believe it or not, Elizabeth Warren, 50, 30, 20 method of saving, spending, and basically enjoying your life. Try to run your core expenses on 50% of your income. If you can do that, you've already set yourself up pretty nicely. With the 20%, do save that for long-term retirement and other such things. Dave Ramsey has it at 15. Others have it a little bit higher. But if you're saving 20% of your income for your retirement, you're on pretty good footing. And then that other 30%, you have maximum permission to spend that on whatever it is that you want, because your life is going to take place in your 20s, 30s, 40s, and 50s. And you're really not going to have won the game if you get to your 60s and finally allow yourself to start spending some of your money. It's just, I don't think it's a good way to go about doing it.
Because after 30, 40 years of acting that way and not being able to get a cup of coffee, which, by the way, its performance remarkably stable over time.
Yeah.
It performs very similarly regardless of blend.
Exactly.
So, but anyway, I guess what this is a hard switch to flip is what I'm saying, is that if you are super frugal for 40 years, you're not going to just be able to start splurging. It's going to be a challenge. I'm not going to make any broad assumptions about what type of person you end up being, but it's going to be challenging to loosen up a little bit.
Yeah. And I think that getting into that spending mindset, you might need permission as a type A person. And maybe you can allocate every month. Here's the 30% that we can spend on shoes, Amazon, Netflix, whatever the case might be. But I really don't think that a cup of coffee a day or your Netflix subscription is going to be the deciding factor between great retirement lifestyle and, destitute.
Totally agree.
All right. Next video.
Leasing a car is the biggest waste of money out there.
I lease a car.
So why?
I think that I want to not have to deal with an older car, and I can lease it for a few years. It's cheaper. I don't drive it very much. I don't go over the limit, and I can turn it in and get a brand new car in 3 years.
Yes, but if you keep it the entire time and you look at the money that
what's the entire time?
And the life of it, if you take good care of it, like my car is going to be good for another 5 years. I just think it's better to buy.
I think that this is our first Suze Orman appearance on the
I think you're right.
And I mean, if we talked about FinTalk segments and Financial Mythbusters, this is our first Suze Orman. So welcome to the show.
Welcome to the show.
She, much like Dave, I do need to give credit where credit is due, has written a lot of personal finance books. She does have a lot of good content. She has helped a lot of people. I like to preface what we're going to say with that. However, and we were talking off air a little bit about this, these kinds of analysis when it comes to the car buying, leasing situation, debt, no debt, car note, cash payments. This is where I fall on the side of people do not buy or lease cars as an investment. I think right out of the gate, wrong kind of analysis. And yes, they both cost money and they will both have a future value, but no one except for collectors is buying a car as a legitimate investment scheme.
Yeah, you're buying it because you need a way to get from point A to point B. And that's most of it. For most people, there's some cargo requirements, people or a flatbed if you need
absolutely.
a truck or something like that. But you're mostly trying to get from A to B. And I would say that he pokes a really good hole in her entire argument when he says, "What's the life of it?" She said, "Keep a car for the life of it."
Yeah, the whole time.
The whole time. We have no idea what the life of a car is.
None whatsoever.
It could be 5 years if things go poorly. It could be 20-something years if everything works perfectly.
Yeah.
So I think that is a little bit short-sighted just in terms of we don't know exactly how long this car is going to last.
Yeah, and these kinds of analysis regarding, I think, goods that can be viewed as, in the wrong light, a luxury good, reminds me of a comparison where it's like a young guy is talking to an older guy, story, definitely apocryphal, where he's like, yeah, I've been really saving money. We don't really go out to eat. We don't do, fancy vacations. Like he's talking about what he's doing with his wife. And he's like, son, why would you not do those things? He's like, oh, because they're expensive. And he goes, have you tried divorce? And it's like, that's very expensive. And I think when people make this kind of analysis on a thing that is a utility, like a good that they are going to use to get themselves from home to work, to pick up their children, they're going to have, in many instances, cargo in that vehicle that they don't want to be damaged or stolen or what have you. And yeah, like you said off air, everybody could probably get the job done to a certain extent with a Toyota Corolla they bought for cash, and it's like,
if 2007.
An 07 Corolla, it'll get you from point A to point B.
It will.
And there's a case to be made there. I get it. If you want to optimize for durability, buy Japanese. You know what I'm saying? But in this event, it's like Wallace is pointing out that he just has tastes that vary in degree or kind from the type that maybe your typical Suze Orman listener or reader have.
Well, and I think you could also argue that his other point is, I'm going to guess that Mr. Wallace does not drive from Washington to LA and back frequently. So, I mean, if he's driving like 4,000 or 5,000 miles a year, then maybe a lease is a pretty good fit, because then he doesn't really have to worry about maintenance, and he's just not worried about what he's going to do with the car in 5, 6, 7 years if it's a really long payment schedule.
Yeah, and I think it can be an analogous situation would be to the rent versus buy on a home, where a lot of people are in the camp of buying a home because you can build equity in the home. But some people will certainly caveat that and say, if you intend on moving in the next 2 to 5 years, why would you go through the rigmarole of getting the mortgage, paying the closing costs, doing all of the ongoing maintenance, only to have to go through all of that again, pack up all your stuff, and do it again somewhere else? It's like, so you're going to go through a sale or a buy, and then a sale, and then another buy in a 5-year period. It's like, no thanks. There's a really good point to be made there to rent, or a really strong case to be made there to rent. And it's not just, throwing money in a bathtub and lighting it on fire. And I do, as a brief aside, where she's like, it's the biggest waste of money that I could ever think of. It's like, as a man who has bought his children several easily destructible toys, I can think of several dozen more ways to waste money than leasing a car.
Yeah, I'm sure I could come up with a few as well.
Yeah.
But I guess in addition to this, the other thing I would say as maybe a final thought on this is the worst decision you can make compared to what?
Yeah.
So the other choice of, if we're talking about buying a car with cash, then yeah, she's probably right. But if the other option is a high interest 72-month loan, I would go lease every single time.
Yeah.
Because one, you could wreck that car and then you're underwater in it almost immediately.
And you owe the money.
You owe the money.
Yeah.
And two, you've got interest payments that could be significantly higher than what you're averaging on the lease payment.
Yeah. So again, and this is going to be true for many of the videos we see in this segment, there's nothing that she's saying that I would say is factually incorrect, aside from it maybe being the biggest waste of money of all time. That's somewhat subjective. But it's like, yes, is leasing a car of the 3 options that you typically have to get access? I suppose Uber's kind of a 4th option now. Buy
the bus,
buy versus, buying cash versus buy with a loan versus lease. Yes, lease probably on average is your more expensive way to do it. But if used appropriately, like what Chris Wallace is saying here, it can be a totally fine option. And I don't think we should make people feel bad about doing it.
Yeah. And I would say that a lot of these FinTalk videos that we're looking at, it's efficiency to like an extreme level where you're kind of losing the point of why you were doing it in the first place.
You've lost the goal of the goal. Yeah. You've lost the plot. All right. Next video.
I invested in one laundromat that did $3 million a year.
So it's doing like $8,000 a day.
Yeah, they do 15% margins, and the way they do them is actually through the wash and fold business, not the walk-in laundry business.
Okay, gotcha.
And so the real business where the higher level customers are and where you make more money is single mom wants to put her bag of clothes outside of her door. You pick it up, you wash it, you drop it back off. It requires cars and logistics and some oversight. It's more complex. The average laundromat makes somewhere around $100,000 to $500,000 a year at 10 to 15% margins.
How many laundromats did you buy?
In total, I probably owned like 25 or 30 laundromats over my career of laundromatting.
Okay, well,
I think I would probably know exactly how many laundromats I own personally, but that's just me.
You wouldn't have to guess?
I wouldn't have a round figure on it.
Yeah. Well, my round figure is 0 at this time. And I would venture for most people listening that their number is probably going to be 0 and remain 0. But we felt it appropriate to kind of address Cody Sanchez is sort of in vogue right now with the Main Street Millionaire kind of investment mindset. And I think, again, not necessarily anything that we can point to here that's factually incorrect. I'm sure she knows the economics of laundromatting better than maybe anyone at this point.
We are not licensed in laundromats.
I think, no, we are not. I think that how you and I would probably approach this sort of investment is, yes, it's great if you can look at this and you can build not even a rental real estate empire, but a laundromat empire. It's new, it's out there. That's for sure. But she, even in this video, sort of gives the game away where she says your typical laundromat that's not doing the very high-end wash, fold, press, return, pickup service, where she said, I think one was doing like $3 million a year. That couldn't,
8,000 a day.
Yeah, that couldn't be I imagine that has to be a collection of laundromats, or maybe not. But $3 million a year at 15% margins. You can check my math here, but you're taking away a pretty decent profit.
That's
on
the
that.
Buc-ee's of laundromats.
Exactly. I do love Buc-ee's. We should have, but anyway. But so I think what we're going to approach it is like what goes unsaid in many of these videos are the risks.
Mm-hmm.
And so Cody Sanchez, she had a very successful career actually in the financial services business or industry ahead of when she started doing this sort of Main Street Millionaire style of investing. And then I want to make sure people understand Cody Sanchez as an individual did not own the vast majority of those laundromats. She owned those through some LLC structure, which does absolve an individual from very specific business risks if you are going about this as a sole proprietor. That probably doesn't make the video because it's dry, boring. It's kind of the stuff you and I do every day.
Yeah, it's the legalese behind the idea.
And then in another video, I'm not sure we're going to go over it, she talks about how they were able to raise capital. So they were able to go to the debt markets and essentially either get investors or just raise debt from other people to buy these laundromats. And that immediately raises a red flag for me because now you owe somebody something. And if your business doesn't produce it, they'll come after you for it.
Yeah, I think the first thing, my question about this is a pretty low margin business,
Yeah.
I would say. So the cost of capital is really important.
Yeah.
Because all right, so you need, say $300,000 or $400,000 to buy a laundromat that's going to produce $50,000, $60,000 a year. That's like a 6 or 8 times multiple, depending.
Uh-huh.
If you then add, you're borrowing money at even 4 or 5%, it's going to take a long, long time to break even off of a laundromat purchase.
And then in this kind of investment where it's like in the area in Houston that I live, I drive down to the corner of 2 streets that are pretty close to where I'm situated, and there's 4 or 5 laundromats. And so it seems to me like it's one of the businesses, it might have been Peter Thiel who said this, don't quote me on that or directly, but I think he said you want to avoid commoditized and undiversified businesses. So unless I'm not understanding this business appropriately, and I'm sure there are things that I don't understand about it, I really don't know how you differentiate yourself in that business.
I mean, I guess from the video, I would say that maybe those 4 or 5 are only, walk-in coin op machines, and that you would differentiate yourself by offering this fold and wash and fold service.
So you could add additional service for additional costs, right? But my worry is that the market of individual, and I really don't mean anything by this. I don't mean to degrade anybody on this. I'm venturing that the market of individuals who use laundromats are generally pretty price sensitive, because what that would indicate is you probably don't own your own washer and dryer. And then maybe, like what she was getting at with the top tier service, maybe those are people who could own their own washer and dryer, but have the financial flexibility to outsource this kind of thing.
Yeah.
But even in that case, I would venture that a big part of that market has their own washer dryer and hires a person to come to them to not only do their laundry, but also to take care of a range of other, household things, maintenance things that needs to get done. So the total addressable market for a laundromat, I'm just not sure, it's really hard to compete on anything other than price and maybe location. And again, I don't know what you do to differentiate yourself.
I feel like there could be geographic differences too. I don't know. I feel like in Texas, a lot of apartment buildings have their own laundromats
for sure.
Kind of attached. So maybe other places they don't. So that would contribute to this maybe being a better idea.
Yeah. And again, it's like when we're talking about sort of our take on this is if a young person came to us and had I don't know, however much money it was to spend. And this was something you guys were talking off air. When you're talking about a business that's going to give you 10 to 15% margins, and those are probably the good ones, because what's left out of the analysis are all the laundromats that failed. You don't ever hear a headline, laundromat fails, because it just happens. It's just not that big a bit. You know what I mean? When a company like Enron goes bust, everybody hears about it.
Theranos.
Yeah, but when a neighborhood laundromat closes its doors, nobody hears about it. It doesn't make it into the paper. But if someone came to us and they were young and they had this kind of money to invest, I'm not sure that a laundromat makes my top 25.
Yeah. And the other kind of joke comment that I had earlier was that a laundromat doesn't pay you in slightly more laundromat.
No, it doesn't compound.
You can't reinvest your dividends.
And that's a big deal too, because it seems like if you really wanted to own an empire of these things, you would have to rely quite heavily on raising capital or going to the debt markets in order to get financing just to own more and more of these laundromats. And then the other thing we talked about, which was a little bit earlier, unless you are specializing in this kind of business, there's so much more money to be made focusing on your career than to be made on these side quests. Where it's like, oh, I invested in this laundromat. I have to pay insurance costs. I have to pay taxes on the real estate. I have to pay my employees. Everything's an HR problem. It's like that seems to me like a huge time suck.
I hadn't heard this described as side quests before. I really like it.
Well, I mean, I think that's the way that I would describe the same people who get very interested in rental real estate for tax purposes.
Yeah.
And like we could do a whole episode just on that, and I'm sure that we will at some point in time, but I worry, and again, I think that Cody is probably exactly right in that there are a lot of people who are retiring from these Main Street businesses, as she calls them, and they don't have anybody who's looking to buy them. And so for some people, they see that as, wow, here's a really great opportunity. You can buy these businesses for maybe pennies on the dollar, but I guess maybe because I'm a little bit more risk averse, my thought is, why is nobody buying them? You know what I mean?
Yeah.
It's like, why? It's kind of like if you've tried your hand at taking a bunch of girls out and you're not having any success, it's probably not the girls, it's probably you. And so that's the same thing. It's like if these owners are trying to shop these businesses around and they're not getting any bites, it's probably not the young people who are just too lazy to run these businesses. It's probably the economics of the business.
Yeah. And I think, and we'll probably go into this in the next video, it's just, you got to understand the economics of whatever this particular branch of a business is.
Yeah.
Like a laundromat is not a monolith. There's all sorts of different ones that serve different neighborhoods and clientele.
Yeah, absolutely. Well, that wraps another edition of our, I guess, Financial Advisors React to Fin Talk segment. We're still workshopping the name.
I was going to say it's a mouthful.
That was a mouthful of a name. We'll come up with a more parsimonious name, I suppose, for the segment. Advisors React is
Advisors React.
That's what producer Hannah is now shouting at us. But we covered a lot of ground there. I think, again, we can return to a good saying about fundamentals. It's something a lot of people know, but that few people do, and that there are probably better things that you can do with your money than some of the things suggested to you here.
Agreed. And if you like this kind of content and want to hear more about Fin Talk goings on, hit the subscribe button.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.